Well, hey everyone. It's Friday the 13th. It's November 13th of 2020. Not only is it Friday the 13th, but it's the year 2020, which is going to go down in at least uh, history for the next 50 years as being quite a year. Hopefully, we don't have another repeat of this. Uh, I'm optimistic about the chances of them coming up with a vaccine or an effective treatment for COVID-19. So certainly excited about that. I will look forward to when it's available. You take it and we can get back to maybe get things back to some kind of a new normal that won't be like the new normal we're facing right now. So at any rate, the material I'm going to cover in this recording is going to be from your final chapter for this semester. It's chapter 13, Analysis of Financial Statements. And we're going to use for our purposes of our discussion, we're going to use the Need to Know 13-4, which is a comprehensive financial statement analysis problem. This chapter is very important going forward, particularly for those of you that are not necessarily accounting majors. But I would say it's equally important to all of you, but more important in terms of you're not going to see a whole lot more accounting in your academic career. This chapter here is going to be kind of important, and it's going to help you in other courses, the least of which will be not the least of which will be your strategic management course, which comes up at the end of the program, and which you have to do your big end of program project. So do pay attention, do take good notes, and do try to save this information for going forward. You will want to be able to refer back to your knowledge of financial statement analysis. So, all right. So then, why are we doing this? Well, one, we want to be able to compare. That's what we want to be able to do. When we look at a set of financial statements for a company, of what use are they if we're not going to be comparing it to something? If we're looking at the individual company itself, we might be comparing it with itself over time. In same periods, we may be comparing it to competitors or to a segment of the industry that it operates in. And we may be looking at maybe some guidelines or rules of thumb, maybe some standards that have been established that we can look at and compare. So that's the purpose behind needing to know this and why these are important measures to be looking at. Again, all of this information is derived from the financial statements themselves. Now, in the larger picture, analysis, business analysis can incorporate non-accounting or non-financial information with financial information to make some very interesting measures to be able to analyze a business and incorporate a greater number of variables than traditionally examined by, say, your accountants. So keep an open mind that this is just an introduction to a very broad field of analysis. It's a quantitative analysis that right now we're going to stick pretty close to home, and we're going to stick to the financial statements and to things that we can do with that information that we have available to us. But understand that this is a bigger topic and can encompass areas outside of accounting information as well. Okay, so a couple of things we're going to be looking at. We're going to be looking at, well, what kind of analyses are we going to do? Well, there's going to be several different types of analyses that you're going to be performing. First of all, you may be looking at doing some form of horizontal analysis, which basically compares financial condition and performance across time. You may be doing some kind of a vertical analysis, which basically takes everything to some kind of base amount. So in this case, we might be taking everything as a percentage of sales on the income statement, or a percentage of total assets on the balance sheet, and comparing all the line items that are being reported to that base amount. And so that's what we call kind of a vertical analysis. And then we have ratio analysis. And ratio analysis looks at key relationships between items in the financial statements. And they could be within the same financial statement, or they could be across financial statements. When they're across financial statements, like if we're going to compare something from the income statement to something in the balance sheet, you often have to make some adjustments. Again, because the income statement is a period statement, it kind of paints a picture, or maybe more apt, a video of what went on from the beginning of the year to the end of the year. Whereas the balance sheet gives you a picture of what it looks like at the end of the year. And so oftentimes what you end up needing is two balance sheets to go along with the income statement to perform any kind of meaningful analytic calculations. You can also be looking at just changes over time. So you could look at a percentage change. A percentage change just takes the period amount minus some base period amount divided by that base period amount, and then multiply it by 100, and that gets you the percentage change of a particular item. Again, the dollar change is just the period amount that you're looking at minus the base period amount. So you don't divide it and multiply it by 100. So, and then you can look at trend percentages. So you can look at trends by taking the analysis period amount, the period amount that you're looking at, and divide it by some base amount that you use by way of comparison, and then multiply that by 100, and you have a trend percentage. So you've got a number of different ways that you can do this. You can also do what they call common sizing. We can common size balance sheets, and we can common size the income statement. Essentially, that takes the amount that we're going to analyze, the account or line item that we want to analyze, and we're going to compare it or divide it into by the base amount. So I think I referred to earlier, everything could be seen as a percentage of total assets, or everything could be seen as a percentage of sales. And you could common size your entire statement. And that's meaningful because it allows you to compare firms of different sizes with one another. Kind of puts everybody on a level playing field. You're looking at percentages as opposed to raw dollars. And so now you're beginning to look at the proportions, how things are allocated throughout the financial statement as opposed to just raw dollars. It can be very difficult to compare two firms. If one firm is 10 times the size of the other firm, it's sometimes difficult looking at raw dollar amounts to really see what's going on and determine what are the similarities, what are the differences, what are the strengths, what are the weaknesses. It's much easier to see that when you've turned or converted all of the figures into a percentage, and you do that for both firms. Makes it much, much easier to do that. And of course, you can create a lot of visuals. In Excel, you can create a lot of graphs. You can do some basic visualization, or you can take it into something like Tableau or Power BI, and you can get into some real hardcore visuals. And boy, I tell you, that's some amazing software. And depending on what classes you take going forward, I know if you take some classes with me in accounting, you will be exposed to some of that software. I plan on trying to get everybody exposed to Tableau as I go along, and I would like to try to use some of Power BI. They're both very similar. And I would like to get students to get their hands on both of those because I think they're very powerful tools. And so you're going to be looking at a number of different ratios for ratio analysis in addition. There's a really good summary of the ratios on page 511 of your textbook. That's the nice thing about this book that we use, is they really do a nice job of kind of wrapping up the information for you. And so it's a nice summary of ratios there. Now, calculating the ratios, that's what we're going to be focused on now. Later on, for those of you that take Accounting 3800, which is Understanding Financial Statements, we'll be moving from just calculating ratios and calculating common size statements to more analysis, where you begin to say, what's happening? What's going on here? What can we do with this information? So for now, it's good enough, and I'll give you some basic explanation here and there, but not a whole lot. So I want you to go through this need to know. This is going to be important, especially as you move towards your final exam. So the need to know 13-4 asks you to apply horizontal, vertical, and ratio analysis to the financial statements of a fictitious company called Precision Company. So for requirement 1, they want you to prepare a comparative income statement showing the percentage increase or decrease for the current year in comparison to the prior year. And then they want you to prepare common size comparative balance sheets for both years. And then they want you to compute the ratios for the current year and identify each one's building block category for a financial statement analysis. So that's what we're going to be taking a look at. So we'll take a look at the information that's been provided to us. They've given us comparative income statements here for the current year and the prior year. And they've also given us comparative balance sheets for prior year and current year. And you'll have to scroll all the way down. Okay, so the first thing they're going to want you to do is we're going to set up the change. Okay, what is the change calculated as? So we have a prior year and a current year. So consider the prior year kind of your base year and the current year as the year of analysis. And so the change from the prior year to the current year was $411,000. Okay, so then what does that equate to as a percentage? Well, you have to divide it by that prior year amount to figure out what the percentage of the change was. And so you would get 19.8%. So again, if you were to do this on your calculator, very simply, you would take the 2,486,000 minus 2,075,000 equals 411,000. Divide that by 2,075,000, and you get 0.198. Multiply that by 100, and you get 19.8%. And you would go through and you would do that for all of these numbers, and that's how you would calculate the change. And again, if the current year's number is higher than the prior year number, the amount's going to be positive. If the current year amount is less than the prior year amount, then the change is going to be negative. Okay, so and you could work your way all the way down through the income statement, through all the different steps, and come up with what the changes are. Okay, now again, when you're looking at the individual changes and interpreting these things and what do they mean, you kind of have to look at the big picture. So yes, nearly a 20% increase in sales is a good thing. The cost of goods sold went up a little bit more, 24.6%. So relative to sales, cost of goods increased just a little bit more there. Gross profit increased by 12.9%. So the increase in the cost of goods sold offset a little bit of the increase in sales. And then you look and they had a pretty significant increase in their advertising expense on a percentage basis and on a dollar amount basis. And you can go through and look here and see all of the different changes. Insurance expense went up by 122.2%, or by $55,000, so that was a lot. So when you get to the total operating expenses here, when you're netting all these changes, it ends up being a 3.7% increase in operating expenses. And so your operating income has changed significantly. It went from $103,000 in the prior year to $185,000 in the current year, which is an increase of 79.6%. So it's a pretty significant amount that you're seeing an increase. And you can look at it by just saying, okay, we're looking at these differences here and looking at the change in the gross operating profit. So we look at the change in the cost of goods sold relative to the changes in the operating expenses. And so still, even though our cost of goods sold increased and our total operating expenses increased, it was such that the increase in sales was significant enough that we end up with a fairly sizable increase in our operating income. And then you have your other items. Interest expense, income before taxes is up quite a bit, and of course then income tax expense is then going to be up about the same amount as in terms of a percentage. And then you've got your net income and then earnings per share. And notice these numbers are very consistent, and that's because the income tax expense is based on the amount of reported income before taxes. And your net income is going to be similar in percentage. And then, of course, your earnings per share is going to be similar in percentage as well in terms of the amount of increase. So we would expect that. But all in all, if you look, this seems like it's all very positive for this company in terms of the change from one year to the next. Okay. Now let's look at the comparative balance sheets. And the way we would look at this here is everything's going to be based on total assets. So everything is a percentage of total assets, which should total 100%. So cash, prior year was 2.5%, current year is 4.7%. So the gross amount of cash has increased, and it's also increased as a proportion of total assets. Short-term investments has decreased slightly, both in real dollar amounts and in the proportion of total assets. Accounts receivable has gone up in real terms and also in its relation to total assets. Merchandise inventory is down from the prior year. And then your total current assets is holding almost steady, 30% last year, 30.5% of total assets this year. And then we look at the other asset mixes here, the longer term assets. You've got your plan assets, and that's really all they have. They don't have any investments here. And so plan assets make a total of 70% and 69.5%. So they've got a lot invested in their stores and equipment and buildings. Okay, so store equipment and buildings is where most of it lies. And they've got some land, but they haven't done anything with it, and it holds its own value. Remember, we don't depreciate land. So, and you can do the same thing for liabilities. You look and you see your total liabilities and equity is 100%, and then everything becomes a percentage. And so you're looking at your total stockholders' equity is 57.6% and 60.5%. Their total liabilities is 42.4% and 39.5%. So in terms of debt to equity, they lean towards the equity side. And also when you look at their long-term liabilities, they do have some long-term notes here. And so they have notes payable secured on mortgage of the buildings. So that's their extent of their long-term debt. And then their current liabilities. Accounts payable is down as terms of a percentage of total assets. Short-term notes payable is down as a percentage of total, and taxes payable is up a little bit. So all these trends seem to be okay to me. Nothing jumps out. It says, from an operational standpoint, none of it jumps up at me and says, ooh, there may be some percentages in here that from an auditing perspective I might want to take a look at, but that's for another day. We'll talk about that later. And then this last section here, of course, shows you the calculation of the ratios. And so again, the current ratio is current assets divided by current liabilities. And so this looks at liquidity and efficiency. So liquidity, when you think about liquidity, think about how liquid a company is. So how capable are they of discharging their responsibilities, their liabilities, what they owe other people. And so in this case, their current assets to current liabilities is a 1.9 to 1, which is almost a ratio of 2. That's a solid number. That's a benchmark number. You want to be at least 2.0 for your current asset. Now, when you get into asset test ratio looks at only certain current assets. It looks at your cash. It looks at your, I believe, your short-term investments, and looks at the accounts receivable. And so those are your most liquid assets that you have, and it's at 1-to-1 with the current liabilities. So all in all, I would say with a current ratio of 2 and an asset test ratio of 1, I'd say they're in good shape there. Those are numbers that we would be happy with. Again, without knowing anything else, that's about all you can say. Average receivables, and then the accounts receivable turnover here. So we calculate our average receivables. It was 100 the prior year, 120,000 the current year, divided by 2. So that gives us an average for the year of $110,000 in receivables. So our turnover is going to be the sales of $2,486,000 divided by the average receivables, the average accounts receivables of $110,000. So that means that we turn them over 22.6 times. So that's not bad. We're turning over our receivables quite well. How long is it taking us to collect? Well, it's taking us on average 17.6 days. And we calculate that by looking at the receivables for the year divided by the sales times 365 to translate this into days. And so again, it shows us how quickly are we collecting cash from our customers. And I would say, you want to be under 30 days, obviously, because if your payment, you're always going to be looking at this relative to your payment terms. If your payment terms are net 30 days, then 17.6 days is probably pretty good. If your payment terms were net 10 or net 12 or net 15, then maybe this would seem a little bit high. So everything's relative to something else. The average inventory, again, you take your inventory numbers from the prior year and the current year, add them together, divide by 2, and you get your average of 257,500. You want to know your inventory turnover, okay? So your inventory turnover is going to be a function of your cost of goods sold. So you come up here, going to scroll up. Cost of goods sold was 1,523,000, and you can come down here and see in the ratio that's what they've used. They've used 1,523,000 divided by the average inventory for the period, and so you're turning your inventory over 5.9 times. Is that good or bad? Well, you don't want your inventory sitting around because then it has a chance to become obsolete or become damaged, or it could be stolen. So you don't want inventory turning around. So the more times it turns over, the better, but there is a point where if you're turning it over too many times, it could lead to out of stock situations and sales. So that's something that you need to keep an eye on. There's a balance between having a favorable inventory turnover rate, but not being so high that you're running the risk of losing sales because you're out of stock. The debt ratio here is we're looking at solvency. And so we've got $665,000 in debt to equity, 1,684,000. That's your total liabilities and equity. So what portion of that is made up of debt? And it's 39.5%. And so that's not a bad ratio. Again, what does it mean? You're going to want to track this over time, and you're going to want to compare it to the industry or to individual competitors to see how you're doing relative to them. You don't want to be so out of line, and you want it to be consistent with whatever business strategy you've chosen. If you're in an expansion mode and you need cash, you may be taking on some debt. But you always have to be careful because whenever you take on debt, there's something else that comes along with it, interest. Interest is something that you have to pay. You can't not pay it. And so you don't want to default on your debt. So there is a difference between raising money through capital raising campaigns such as selling more stock or contributing more money from the owners or going out and selling bonds or getting loans. Selling bonds, getting loans, you're going to pay interest on that. The debt to equity ratio is just, instead of the debt ratio being debt to total debt plus equities, this is going to be debt to equity, and it's 0.65. And this is another solvency ratio. So it tells us the percentage of debt to equity. So our equity is 1,019,000, right? Our total stockholders' equity. Debt is $665,000. And so we have a 0.65 debt to equity ratio. And again, you probably want to keep that in the favorable range, less than 1. Go over 1, that means you've got more debt than equity. That could lead to some problems with cash management. It could preclude you from taking advantage of opportunities in the future that you would like to take advantage of that would be good for your business because you're taking on too much debt. All right. Then you've got times interest earned. Times interest earned is going to be a function of, let's go up and take a look to see where they're pulling these numbers from. Okay. So we want to come up here and we're going to be looking at this, and we say we're looking at operating income of $185,000. So they're comparing their interest expense here of $44,000. They're comparing it to operating income, and they're calling this times interest earned. So we'll come back down to the calculation here. And so times interest earned is going to be 4.2 times. So that means that our operating income is 4.2 times the amount of interest expense. Okay. Again, that number by and large by itself is not necessarily very meaningful, although you do want to be earning more than you're paying out in interest. I think that's that seems like common sense, but it's true. But this number is something you want to track over time, and you also want to be comparing it to any industry standards, industry norms, industry benchmarks, or amongst a peer set of companies that you want to compare a company to. And then the profit margin ratio, you've got 94,000 back to sales, and you've got 3.8% as your profitability. And again, what does the 94,000 represent? We'll come back up to the income statement and take a look. And that's your net income. So it's taking net income and relating it back to what you started with, sales. How much of every dollar in sales are you keeping for net income? That's basically what that question is answering. And so you come back down here and you see that it's 3.8% or 3.8 cents of every dollar. Okay, so 3.8 cents of every dollar is going into the net income. So then we have the total asset turnover ratio. And so we need to have our average total assets. And so we take our total assets divided by beginning of the period, end of the period, right? We divide them by each other. We add them together. So we have, at the end of one period, we have 1,678,000. And then we have in the next year, 1,684,000. We divide them. Again, anytime you want to come up with an average, you add up the ending of the 1 year, the ending of the next year, divide them by 2, and that gives you your average. In this case, it's 1,681,000. Then to calculate the total asset turnover, we're going to take the asset average that we just calculated, and then we're going to divide it into the sales figure for the year. And so that's going to give us 1.48 times. And so this is a measure of liquidity and efficiency. It kind of tells us where we are in terms of using our assets to generate sales. And so are we generating more sales than we have invested in assets? And so again, what's the value of this? The value, as with all ratios, it's about comparison. And so you can compare a firm with itself over time, and you can compare it across a set of peer companies or with some benchmarks or rules of thumb or with a set of peer companies. All right. So what's the next one? We have some return. We have a return ratio. This has, anytime you see return, that's a profitability ratio. So we have return on total assets. So we're using our net income number of 94,000 divided by that average total assets that we have. And so we come up with 5.6%. All right. The other way to look at it is you can take it and you can take your total asset turnover ratio of 1.48 and you can multiply that times your profit margin ratio of 3.8%, and that will get you 5.6% as well. And what that leads to is into a discussion that you'll get into later. You'll be looking at models like the DuPont model. What they do is they look at the relationships between these different ratios and how you could use them in different combinations. So you can calculate return on total assets if you have the raw numbers, but if you have the asset turnover ratio and you have the profit margin ratio, you can calculate what return on total assets happens to be. You just multiply the profit margin ratio by the asset turnover. Average total common equity, okay, we calculate that. Why? Because we're going to look at another return. This is going to be return on equity or return on common stockholders' equity. First, I'll go back to K here. Return on assets, sometimes you'll see it abbreviated as ROA. This one you're going to see abbreviated as ROE, return on equity. They just happen to be calling it return on common stockholders' equity. So again, it's net income divided by the average total common equity. We calculated the average total common equity by taking the ending of the both years, adding them together, dividing by 2. We come up with $992,500. And so that's what we're going to divide into the $94,000 of net income, come up with 9.5%. And so again, that's a return figure. What is the value of that particular return figure and the value of the return on assets figure? Well, it triggers us to know how well are we generating profit from our assets and our return against what the stockholders have invested into the company. And those two are important measures. But again, any of these ratios, the value of the ratio is not in a single number. It's going to be looking at trends over time within the same company. And it's also going to be looking at this company relative to other companies, relative to any segment of the industry in which it resides, and against any benchmarks or rules of thumb that are out there. That's what you're going to be wanting to do, and that's what you're going to compare it. And you're going to want to be able to tell a little story about what's going on with this particular company. All in all, I would say this company is operating. They're operating good health, good financial health, and say as little as possible. Sometimes less is more. So if you don't need to say a whole lot, don't say a whole lot. Just use the examples. You can use these examples here to make the case. If you want to say that the company is financially healthy, it's profitable, you can say that, and you can support it with the numbers that you have here. Okay, that's what you want to be able to do. You also want to be able to get into, why is the ratio for the current ratio, is it 2 to 1? What's really driving it? Again, you'd have to go back to your comparative balance sheet and look at the numbers here and see what's driving the current ratio. All right. And so in this case, the largest asset you have is inventory, merchandise inventory. But remember, our merchandise inventory decreased slightly and cash increased slightly. Okay. And accounts receivable increased slightly. So what we have going on here is, even though we are weighted towards inventory in the current ratio, we do have a trend where we are increasing cash and we're increasing accounts receivable. Cash, of course, is already liquid, and accounts receivable is considered very liquid. And so that would be maybe seen as a positive trend in that ratio. And of course, when you're going to look at the acid test or the quick ratio, you're just going to be looking at these three numbers right here: cash, short-term investments, and accounts receivable. And the big driver here, of course, is going to be accounts receivable. All right. So cash is the smallest of the three components. And so that's what's driving the quick ratio here. Okay. So primarily accounts receivable. Secondarily, it's being driven by the change in cash. And then lastly, by the change in the short-term investments. So that's what you're going to be looking at. So at any rate, well, that's what I've got on this. This chapter is pretty straightforward. Again, the calculations, the important part is going to be doing some memorization. Now, you're not going to have to memorize for your final exam for any questions related to this, because you're going to have your book with you. And so, but I do recommend, I strongly encourage and recommend to you that you begin to memorize some of these ratios. As a matter of fact, I would scan or make a photocopy of page 511 for yourself, because it gives you a lot of the basic ratios, and you're really going to need to know them and know about them. You'll need to learn more going forward. And again, for those of you that are going to take me in Accounting 3800, or take Professor Ryle or Professor Haverland in that course, you will be spending a lot more time on understanding what these calculations represent and what they mean. Like, how do you interpret them? How do you tell the story about a company? All right. Well, thanks very much. I appreciate your time. Hopefully you got something out of this. And so again, this was the kind of the summary wrap up for chapter 13.